All right, joining us right now to talk about what's happening in the markets is CNBC contributor Peter Boockvar. He's the chief investment officer of the Bleakley Advisory Group. And Peter, you've got some interesting thoughts in your book notes today, your morning report. We've been looking at oil prices this morning, trying to figure out why they're higher, even with OPEC Plus agreeing to put more supply on the market. And you've got some very interesting points about what's been happening with the rig count. We always say that low prices are cured by low prices, meaning that producers don't produce if they're not going to get paid appropriately for it. What have you seen with the rig count lately?
That in the entire month of May, the rig count has fallen every week. And now for crude oil in particular, the rig count has fallen to the lowest level since 2021. So to your point, we're in the process of seeing low prices cure low prices. And that the people have to understand that over the last 15 years, U.S. shale has accounted for more than 80% of all non-OPEC supply growth. So there are signs that geologically and also price-wise, the U.S. shale production is topping out here. And I think that that is the offset to OPEC, where while they're raising quotas, they're probably just raising them to what existing production already is.
What is key about this? Is this U.S. manufacturer saying, look, we're just not going to pump at these prices, or is there something else that's taking place here? They're not able to produce more.
Well, it's both. We heard it in just the earnings just reported over the past couple of weeks, particularly from Diamondback Energy, where on a price basis, yes, they're producing less, but on a geology basis, shale basins are topping out in terms of the production. Permian is really the only thing left in terms of adding growth, and there's some signs that that's topping out as well. To my point earlier, U.S. shale has been a major sort of swing factor outside of OPEC in driving energy prices. And I think oil prices here at $60 is dirt cheap, and we're about to see an inflection point here to the upside.
Peter, let's talk a little bit about the steel and aluminum tariffs that are set to go from 25% to 50% this week. What are the implications more broadly across the economy?
Well, obviously, certainly a positive for steel. I'm not so sure on aluminum. I mean, Alcoa, themselves said they're not a big fan of aluminum tariffs. Steel stocks are obviously rallying, but there's a lot more users of steel than producers of steel. So if you're doing construction, or if you're a drilling rig company, well, you use steel to produce some of the product that goes into actually drilling. So it's going to be interesting to see how the manufacturing side is not going to be happy with another spike in steel prices. Take multifamily housing, for example, which flows into CPI. Well, this is not going to be a good cost input for the production of more multifamily housing. So while it's certainly going to help steel, there are a lot of other collateral damage on the users of steel.
Okay. Peter, I guess your point being that the jobs saved in steel maybe are lost in other industries, too.
Probably more jobs lost in the users of steel that are sort of kept and hired within steel. And on a dollar basis, those steel jobs that are created end up costing a lot of money.